Welcome to another episode of Inside the Margins, where we look at how fintechs, banks, and traditional financial institutions assess and mitigate risk. I'm your host, Matt Komos, founder and CEO of Ogma Risk and Analytics. Today I have a great guest on, Juan Sorzano. Juan, welcome to the show, and really excited to have you.
Thanks for having me.
My pleasure. So as we spoke, you've had a career that has really expanded across many different areas, including large scale auto finance, consumer credit in Latin America, and more recently, fintech and student lending. And, we talked a bit about the focus on advanced analytics, AI driven decision systems, which we'll get into through the discussion. But I want to, unpack a bit today how risk actually gets built and led because you've been a leader for some time in environments that are volatile, fast moving, increasingly data driven. We see it a lot on our side and really want to unpack what beyond theory, what does it really mean to implement risk infrastructure and advanced analytics when the pressure is real. So before we get into those details, to start us off, could you give listeners just a quick overview of your career journey and what initially brought you into risk?
Sure. Yeah, I actually started many years ago in banking. So I was actually, my first job out of university was in underwriting in a bank. And at that point in time, I remember very well when the supervisor in Colombia started to change things around, how institutions were, managing risk. And actually, there was a few laws that they put out with a very short, time of deadlines to start pressuring, and that's why in Colombia, kind of institutions and financial services companies started to put together risk organizations and risk practices, not just around credit risk, but any other risk, operational risks, liquidity, everything.
Yeah.
So when I was at that point in time, I moved, after 1 or 2 years in underwriting to risk, and then up until now. Then I had an opportunity to join the GMAC at that point in time to finance cars, and I was the risk manager for the Colombian branch there. And then I started to expand in terms of geographies. And then in 2010, I moved to Detroit, Michigan, to the headquarters. So I was continued to expand our risk management practices for the company across, all countries, including, China, Europe, Latin America. And then I decided for project of life, personal reasons as well, family, go to Spain. And I found, that this was a very good place for kind of joining a very moved market of startups and fintechs and online banking and new things, new technologies that was actually calling my attention. And I started to work as a risk manager in fintechs here in Spain. I would say I'm coming with all this traditional background of managing risk in, I would say, traditional institutions, companies I used to work with, and GM Financial. They are very up to speed in terms of technology and how to move, their things in their portfolios and in the risk management area as well. Now, but definitely we're going to talk about that and what are the key differences that I see in terms of living in a fast world in fintechs versus what I used to experience, in large institutions with many portfolios, with many countries, with many people. So very different, but there's some things in common. There's common ground there, and there's kind of the essence of risk management is going to be still there.
Absolutely. Yeah. And I've had kind of a similar path where I started out in a large institution, HSBC, was a credit analyst, then a senior credit analyst, and then I consulted with, many large institutions and have gotten into the fintech space as well. So look forward to that part of the discussion. Now, I've also done some work in Mexico and Colombia and parts of South America. I'm curious, when you started working there, what was kind of some surprises maybe about managing consumer credit risk on the ground? Like, what were some of those early learnings that helped shape your perspective as a risk manager and risk practitioner?
Well, the first thing, there's two things. One is obviously the data foundations and the data strategy, and second, the process. And they are very related. Actually, good data is being collected through a good process. And in both, I saw a real opportunity. Going back, in time, when I saw the people on the credit desk, when I moved to the bank, to the captive, to GMAC, and seeing people on their desks, right, doing things manually, I say, what are you guys doing?
That seems inefficient, right?
Yeah, but I mean, this is the traditional way,
Of course,
they had,
yeah,
documents, being sent from the dealerships, and then they had some people used to print the credit bureau and check
yeah,
things. I mean, fully manual. So that's where I saw the real opportunity for changing things and capturing, data. We made up everything in corporate is a little bit more difficult, but we had a great excuse because we were supervised. We said we need to move forward. We need to build a system that captures all these variables, from a know your customer perspective, from a credit risk perspective, capture, on our database, the information that we were buying from the credit bureaus, and then building the blocks, to, kind of start doing some analytics and then doing some models and doing some things that would enhance our ability to decide in the acceptance area more so. So obviously, working a few years in the branch in Colombia was amazing, and then we were moving fast because of those pressures that I mentioned.
yeah.
And at some point in time, there was a meeting, all Latin American people. We were in the U.S. in Miami, a meeting about best practices, and I was invited, and I started to show, from a collections recovery standpoint, we can do this and that. This is a behavioral score. We can set priorities with this and that. On the origination side, there's many of the countries didn't have a model. So, the big ones, Mexico and Brazil, used to have a model that they, customized and with an analytical company. At some point in time, first customized scoring. Both Mexico and Brazil had models, but the rest of the countries didn't have.
Right.
So at the end of the best practices, I got basically a number of projects assigned to implement those things that I was implementing in Colombia for the rest of the countries, and that actually transformed into the new risk organization for Latin America in the MAC. So first thing, hire people, right? I'm now, and at that point in time, convinced about having the risk manager near the line of fire.
Absolutely.
So people on the ground is very important. You want to go multi-country, you have to have people that, the processes, the regulations that are close to operations, that are close to the finance guy, to be successful in a multi-country business. Anyway.
Yeah. And that, I mean, I would say, I've seen similar, right, where having that local knowledge base and those key folks on the ground are really important. And I think it alludes to kind of the next question that I was going to ask, which was, so you start out in one country and now you expand your responsibility across multiple areas, multiple countries. And so if you think about, right, there's different economic conditions going on, different regulatory regimes, the data quality is different, right? How do you think about risk management as you expand into these different countries?
Yeah, well, and again, I think that the essence of the processes and collecting the data is kind of the skeleton, but in reality, everything is different in every country. So I mean, the way you collect the actual data that is available in the markets, the actual rules that even if you use similar tools, right, the actual rules that you're going to put in place, the strategies, are just going to be significantly different. Consumers are different. They have different purchase power. The price of the goods and the cars at that point in time was different. Regulations are different. Anyway, and one of the things that is very important is to connect that into practicalities is the availability. Right? I mean, even credit bureaus kind of are different. At that point in time, Brazil was just negative. Chile was just negative. Mexico was full positive and negative. Colombia as well. Generic scores here, generic score there. So one's more powerful in one country, less powerful, etc. Right? Is manage the diversity, which at that point I thought, let's centralize an office here in Bogota, so we had the things that are, common, right? Data feeds, whatever you pick, the reporting, the vintages, the monitoring of the portfolios, right? And those things were centralized to gain scale, right?
Yeah.
As per the credit strategy and the policies, they were, obviously delegated into the local risk manager, and that's what's the initial structure we put. And I think it was working, well. Sometimes, there was these discussions, right? Very interesting in what gets local, what gets central. But at the end of the day, I think it was a very efficient risk structure, and then we had the high data processing and modeling as well burden in a central hub. And that's
Yeah.
how we manage that. And then at the end of the day, when you were now managing a strategy for each one of the portfolios, it was using your tools, using the visibility you have with your reporting tools, right? And put it down on the table and say, well, this is my P&L. This is how much risk we can take to keep the margins healthy. Right, and then it varies. There are countries with higher margins, countries with lower margins for whatever
Right.
of all the factors that I mentioned previously, and that's how you set specific strategies for those portfolios. That's how we operated at that point in time.
Yeah, that's pretty. And were all of those, like the advanced analytics, also centralized? I mean, it makes sense, right, to have all of that in a centralized. You get economies of scale and efficiency. But I could imagine it creates some stakeholder disagreements, and local risk managers want resources for maybe implementations or port, right? So that becomes tough to navigate sometimes.
Yeah, it was as we grew, over the years. That was a need, actually. There was a small, depending on the countries and the needs. There was larger or smaller teams in risk teams in the countries, right?
But yeah,
Because of urgent things that they needed to look or adjust or something. So having the flexibility on the ground to adjust the strategy was an advantage. And then again, you won't change a full origination scorecard in a minute. That's a full project. So those things,
yeah,
the heavy projects were run obviously centrally, and the quick things that you can fix here. Well, the campaign for used vehicles here in Mexico needs to be changed. Those were things that were handled locally. Somehow, information comes back and forth centrally, but generally, business model was solved in that way.
So touching a bit on being in the auto finance world, I've done some work there. It's obviously a different asset class. So not only are you managing across these different countries, but you've got a specific asset class which has its own complications. For people that might be listening, like outside of the auto finance world, what does decision science and risk look like in that day-to-day automotive lending?
Well, sorry, repeat that question, please.
Oh, yeah. So
Will be it. Yeah.
So for those that are kind of outside of the auto finance
Right.
world, what does a day-to-day kind of decision science and risk world look like in auto lending? What are some of the things you have to think about differently than maybe a credit card or an unsecured personal loan?
Yeah. Well, I'm not sure if in my experience, in fintech or in auto, and in more thinking about this central team that will do the heavy lifting on data, on analytics, on modeling, is establish your monitoring routine. I would say that's how we establish our day-to-day. Because, we're talking about people that are not into operations. That's clear for everybody what people are doing. The business doesn't stop. So for operations, it's very clear about how a day by day passes and goes, right? But for analytical people, for a central hub that takes care of these models and these tools, is about establishing a routine. And our guide was based on a monitoring routine. At the end of the day, we started to build a big inventory of the models that were out there, under our responsibility, right? And the thing was tracking them on a regular basis. Some of the models, collections models more frequently, origination models, less frequently, but we were observing like the predictive power decay over time, or if there were any issues in stability, in order to prioritize the task. So actually, I remember this big, matrix we call the country matrix, in which we had all the models by country, and then all the key metrics, and then produce that on an ongoing basis in order to set our priorities. Right? You would say the very next model that is going to be developed, in which we're going to have a full project, is going to be Germany, right? Because the KSDK is showing us that predictive power we're losing here. Right, and then that way, by monitoring the performance of the models, we will decide what's the priority, what goes next, and then at the end of the year, you will have the next one 100% fully organized. Just pass it through management, and then get a few discussions, shift a few projects here and there based on business needs, other than model performance or what we internally see. And that's how you write your route down the next year in an analytical hub. That's how we used to live in that environment.
And when I think about the complexities of auto lending, right? So it's not just consumer behavior and macroeconomic cycles that you have to contemplate, but there's also dealer incentives, right? Collateral values. Those add kind of different dimensions to the auto lending process, right? And so as you just laid out, you had a process to validate and monitor models. How do you think about you've got model driven decisions and human judgment coming in, right? On like things like dealer incentives. How do we test those out? When you've got high volume and speed matters, like how do you balance those kind of things between statistically, analytically based versus the human judgment component? Because I think there's a healthy balance is always good, but how did you go about balancing it?
Yeah, I think, there's two aspects of it, right? One is the process itself, right? And then the other one is the modeling. So for the process, as I mentioned, in the very beginning of our conversation, I was surprised how manual the thing was, right? I mean, and then once you collect the data, once you upgrade your systems, once you have a decision engine, right? Sometimes it doesn't look like a decision engine, and sometimes if it is, it is.
Right.
How can you start, automating your decisions in the process and getting people comfortable with that, right? So we had a race, and obviously keeping the risk levels, keeping the same risk levels, how much you can automate.
Yeah.
Right. So looking at prior manual approval rates, right, and looking obviously at the default rates and, using analytics, decision trees and many beautiful tools to come up with, what are the segments that are subject to automate, because they were going to be approved anyways by the people. And then that's a huge shift when you refocus your people to those edge cases, to the cases that are really hard.
Yes.
Well, this looks good, approved, avoid all, this is obviously, it's going to be, charged offs in the credit bureau, rejected. No, everything that was easy was just taken out by the system and more. You continue the race to get more and narrow that gray zone. But I believe in a coexistence, of a small team, if you will, and have an army of people. That's why you have automation, small underwriters, to have continuous, feedback and everything on what's going on. The goal, increase automation as much as you can, and then keep your efficiency, by having this gray zone or edge cases assigned to the underwriting queue, if you will. And then that's from a process standpoint. Well, I remember, at the beginning, like implementing auto rejections from a commercial standpoint was never accepted easily, right? And then once they realized it was, but then you say, well, let's test it. And then when you test it, and then people realize that they were going to be rejected anyways.
Right.
It's worth it. Exactly.
Yeah.
And that. So process is one of the keys in terms of, having your models and having your workflow deciding for acceptance. And then the other thing that I mentioned was, one was process and the other one was modeling. When you're presenting your models to the business people, right? They want to know what's happening. We all want to know what's happening. And so far these days, I would say that it is still very risky to go with a full machine learning model, black box, super complex things in which you don't understand the drivers, right? And implement that for lending. Every single decision is an amount depending on the business you are, right? I mean, $5,000 or 20 or whatever. So that's important. And I'm not saying just for regulation, because if you are regulated, you have to provide traceability and transparency to what factors are behind those models. So at the end of the day, just putting aside regulation and just pure business instinct, having traceability of the features and the components in your credit score model, I would say is key. And people like those conversations and they like to add value to those conversations. So at the end, keeping these traditional ways of open it up, and they say, these are the drivers in here, and this is the risk direction of this variable. This one is a little different, and the thing is, when you go from traditional modeling to more advanced modeling, you go, the new capabilities adapt better to like non-linear type of relationships. And things of that, right? Because in the beginning you have, this is a feature, fully monotonic. They higher the down payment. They lower the risk. Beautiful. We like it. Go on. There's other things and other variables. If you're collecting, different variety of data, are going to show different, things that are not strictly linear. And then models like, gradient boostings, random forest will pick up, even
exactly
better than the classical logistic requirement.
But if you can't explain it, then that's troublesome, right?
Absolutely. The fact that the feature is there and then you can see it and you can see how it gets weighted and right, that it's not this is a random forest, it's a black box, it's doing well. You have to provide and then understand what's going on. And then for you as well. I feel way more comfortable putting a model that I know well and how the pieces, behind are working and how they build up together to make great decisions. As where in other types of the cycle, when you're prioritizing calls in different stages of collections and delinquencies, you say, just that into, well, let's go and do the full traceability of what's behind this model because, they move fast, you retrain fast, and then you can just optimize.
Yeah, it's more behavioral.
Yeah. Risk is already taken, move, right?
Exactly. Well, it's interesting because with a lot of clients that we've worked with, we will often sacrifice some predictability for more explainability. And we've actually brought back some of those more traditional methods in cases where there was kind of a black box put in place, but there wasn't an ability to understand what went wrong. There was some degradation in the score, but nobody could really point out, right, which features were causing it, So
exactly.
So this kind of segues into my next point because, you were working at this large global financial institution for almost 15 years, and then you made a deliberate shift into fintech, right? Where we often see, I always like to joke, that it's like, move fast and break things is kind of that's a technology mantra, but I see that also sometimes in the fintech world. But what just to start out, like what motivated you to make that change into fintech?
Well, actually, as I told you, I moved to Spain, for some reasons, family,
right?
I have family here, but from years and years ago, I was very interested in, how are they doing things, right? The startups and the fintechs, and so I initially, I was fully motivated by new technologies, not just in the analytical side, but as a whole, technology.
Yeah.
And then go through, new channels. Right? I mean that's the thing here in Spain where I was working with online credit, instant online credit, which is a complete different process compared to someone, looking at a car at the dealership. I mean, that makes a huge difference.
Yeah.
And then, what can you do in a short amount of time? I know the ticket is lower, but at the same time, is volumes that are moving fast, making big money,
right.
multiple transactions. Right. So it is very interesting. And I had my curiosity about how they were doing this. And I saw with my own eyes that actually the technology was more towards the channel, the customer journey, bringing the leads, doing the business. And then it was beautiful, but a little concerning in my view from a mid-long-term standpoint in terms of, the risk-reward thing. And right? Spain is beautiful.
Yeah, and viability, right?
Well, next year, 2026 and 2027 are crucial for all these companies that started in Spain because Bank of Spain is changing and they're going to start requiring a license for doing this activity. So this is going to change. But prior, these years, it's been a beautiful laboratory for doing this. They can charge more. So margins, even if levels of risk are higher, you can charge more fees. Exactly. So it allows people and then these entrepreneurs to build these online banks and then, do profits and do, right? But I found, that me coming from the traditional, risk management school, I was able to fix things, right? From the pillars, the fundamentals, right? I mean, I saw companies here in Spain without a model as well. They had a beautiful set of rules, right, that made sense, but at the end of the day, we needed more complex, or join them in no more complex, in a model, in a more analytical way in order to build, the entire funnel, when they go through.
And something more robust, right? Yeah.
Yeah, well, I mean, using analytics, using decision science.
Yeah.
Because,
Yeah,
and again,
exactly.
I saw that there was a lot of, on the web dev, a lot of
Yeah,
technology on the customer journey, on the systems themselves. But on a data science, on a decision analytics standpoint, I saw, more advances in ones versus others, but still a lot of opportunity to work there. And again, put and implement the actual pillars of, risk management. Building is robust tools for managing portfolios in every part of the cycle, in the origination, which is absolutely key, and also building a loss forecasting model that allows you, to plan in the mid long term. How is this portfolio going to be looking like, for your business plan next year or next 2 or next 3, as well as for doing, the right level of reserves and provisions in your P&L. So 2 key things, you're scoring in each stage of the cycle, if you will, originations and maintenance and collections. And on the other side, having a robust loss forecasting model for planning and then measuring what is that you're doing today is going to generate this, and that, and it's going to be impacting your P&L like that. So that mindset, I would say, is a huge value added that you can bring to these people that are moving fast, just moving technology and then doing business. But the weighting of the short term versus the long term is something that you learn with the
yeah,
years.
right. That's where the experience comes in, right? Yeah, yeah.
Exactly.
Well,
Yeah.
so on that point, did you find, because depending on the fintech, and some are more data driven, or, have some of that risk background, others maybe not. Did you find it a challenge to get buy-in for bringing these more traditional kind of risk frameworks and practices to the fintechs, or what was that
Yeah.
experience like? Yeah.
Yeah, definitely. And of course when you're sitting in a when you're a captain in a boat, right, and then you hear what is happening, the hype of the artificial intelligence, right? Why,
Yeah.
why would you put here a logistic regression, right? That's kind of a dinosaur. But anyway, so those are. But I think that those are the type of values that you show that this is, and I use this terminology. This is my baseline. Now I'm working some models right now, but even if I want to go further into more robust technologies or more complex models, I just do them all. You start from the logistic regression just to see if the data that you're obtaining, for your features are giving you signal, and then you go to random forest, and then you go to gradient boosting, and then if you have a large sample enough to go and try neural networks, you can go for deep learning. Haven't gone to that yet in terms of implementations anywhere, but I'm sure it will be the next step. As long as the business requires more complexity, you go and put a more complex model. Otherwise, why?
Right.
If you have
Right.
no lift, step by step, going from a random forest to a boosting, and you get no lift, why do so, right? I mean, just keep it simple. Is powerful enough. You have to take a look at
Right.
the workflow and what are you doing in the rest of the steps and the rest of the rules. If the model is enough, is predicting enough and robustly, to put your cutoffs and your strategies there. So yeah, that's how I see things, and then obviously what I was mentioning about the entrepreneur and a startup quickly, they want to just Gen AI for lending, what, and then I think one thing's for one thing, others for other, but yeah, there's people, they want the latest and greatest. But I understand that, and that's awesome as well. It's a good challenge.
Yeah, but it's a balancing act, right? I mean, we come across
Exactly.
that as well. Yeah, you have to figure out, where does it make sense to implement? Where does it make sense to create efficiencies? Where are areas that, like, you can't imagine that it would necessarily be, because, if we think about like governance and explainability, as we've been touching on, sometimes as we get more complex and less intuitive, right? The governance and explainability become more of a challenge, and you have to put actually a lot more rigor around it to maintain it. That creates more resource need, right? And so it's yeah, it can become a challenging environment.
Yeah, but it's fun. The pace of moving projects in fintech is amazing.
It is pretty great. Yeah, I mean, because you don't have a lot of the maybe red tape that you might face in a more corporate structure, right? And you're right now, you're at Sakura, correct? They do student lending.
I'm in Becas right now.
Oh, yeah, right. You had been in
Cura was my previous college.
It was previous.
Cura was online. They were doing education as well.
Education.
And now with Becas, which is 100% education.
And how do you, so when you think about like even moving into this asset class, right, you've got, some of these tools at your disposal for more advanced analytics, right? But student lending is a tough one because you have to think about things like employability, future earning potential, right? So when I think about complexity, it's not just in the methodologies, but like the data or the behaviors you're trying to predict. So how have you kind of made that shift into thinking a little bit about future state as well for a consumer that you might be providing a student loan to?
Yeah, it is different. It is different, but it's challenging as well. The one thing is, well, education obviously is very special field, if you will. Here, well, before in Secura and now in Becas, we focus on some, targets like masters, and it's not like going to college 100%, or if the companies are targeting the financial companies are targeting to go to educational institutions and centers like universities, they go more for the masters and post degree type of targets, because obviously financing younger kids is more financing the father or the parents, right? So we are in the area of education. There's a lot of education going on right now with the change in technology that is not necessarily your university degree. That's where these companies are focusing their targets. So and then it comes back to, well, credit risk is how we have been doing it, right? I mean, you have alternative data, you have the traditional data from the credit bureaus, you have your flow, you have your channels, and then you establish your workflow with the models that you build for lending. But employability is a little different. It's very interesting. At the end of the day, there's products in the market about, go study, right? Sign this document, and then once you get to a certain level of income, you start repaying. Wow. I say, wow, that's a very different product, right? I mean, so actually, the actual model that predicts how employable and those levels of income that you're gonna get, given the fact that you have a history, and now you're doing something, towards getting that goal, right? The consequence is gonna be that, and then if the class 1 is success, then I'm gonna be able to collect.
Right.
It is. Yeah. The chain of events is amazing. Managing
it's very different, right?
It's very different. Yeah. It's a little bit more complex because of still. I was saying the target is for people that are doing masters, but as time in these generations, very young people as well as doing masters and everything. So the end is the diversity and the ability to collect data from different sources, right? For those who have working history, get those working histories. The credit bureaus are a must. Alternative data from other sources in the internet, right? Their presence in the internet and other things, obviously fraud. And talk about fraud, which is another,
we could have a whole session just on that.
It's a whole session about fraud. But yeah, so credit and employability. Well, at the end, modeling the employability requires a specific, mix of data. Is not credit, right? Is different. But we have sources from which we get, very good data to create attributes. And then now that we're doing this, it makes me, when I'm doing things on employability, I think about new things on credit as well.
Yeah, so they help each other.
Yeah, because when I think of employability, I build the features and the data. I'm more interested in trends in the field, and then I realized from a credit risk standpoint, there's an application. You take a picture, get your score, and you make decisions. Employability is not that about the photograph. It's more about the film, the movie.
Yeah, the movie.
So
right.
And then building features with the movies are great.
Yeah,
is great. And then there you need nice tools, unsupervised machine learning, and then combine that with supervised machine learning, and again, I would go step by step and increase the level of complexity of the algorithm until you have no lift, right?
Right. Then you're done.
Then you know what's required.
Yeah. Wow. Well, Juan, this has been just an amazing, wide-ranging conversation from building credit risk under pressure in Latin America to decision science, fintech culture, the future of AI in lending. But to close us out, thinking, if we think about what's ahead in the next 5 to 10 years, where do you think credit risk leadership is heading, and what separates the teams that will succeed from those that might struggle?
Yeah, well, definitely being up to date in technology. This is moving so fast that you have to be, try to compete on the velocity, on the how fast the tools, models, algorithms, data sources, things evolve. That's a must. Right, that
Yeah.
the team is focused on change and experimenting new things. And then I would say that from a successful risk team, a successful risk leader is about anticipation. Here at this point in time with the new technology, or 10 years before, or 20 years before, but the actual ability to see the mid and long term using the tools available to project those portfolios and see what the company is doing in the mid long term. I would say that's the key role for the risk manager,
Yeah.
today and tomorrow. So sometimes we get super happy with the tools and everything, but at the end of the day is those tools, you're managing risk, and then credit risk takes time. And then
Yeah.
it takes, you do a pilot, it takes time to get the results of the pilot. So this takes time is something that, for example, fintechs don't understand very well.
Yeah.
Right? I mean,
Yes.
you're doing 12 months, you're doing 18 months, you're expanding your terms in your products. So, we have to build
We need that
curves of those
performance window.
pilots.
Yeah.
Exactly. And then, that's the thing with credit risk. And then, right? So you need to very, very good at showing, this is a very short vintage because we need three or more months more to show that this strategy is doing well, or is right. So it's experimentation and then providing visibility. But again, I think the risk person is gotta be the one looking for the mid and long term, being 100% up to date with the technology that is going very, very fast.
Well, I appreciate your insights. Thanks again for joining Inside the Margins, and happy to speak with you, Juan.
Thank you, Matthew. Thank you so
All right.
much. Gracias. Bye.
Gracias.